Welcome to This Week in Money. I'm Phil Mackesy. Today, Jack Crooks on where oil prices are headed. Ellen Brown looks at credit default swaps. And Mike Shedlock on the latest Greek bailout. We begin with Jack Crooks right after this.
American Manganese Inc. has a manganese deposit in Arizona. Indicated 6.7 billion pounds. Inferred 8.9 billion pounds. Potentially the lowest cost producer of electrolytic manganese, costing only 44 cents a pound. Metal trading near $2 a pound. Do the math. Trading symbol AMY. Visit AmericanManganeseInc.com or phone me, Larry Ray, at 604-531-9639.
Welcome to This Week in Money, the source for market opinions, brought to you by AmericanManganeseInc.com. Here is Phil Mackesy.
Jack Crooks is president of Black Swan Capital. He is a currency trader and investment advisor. He publishes Black Swan Currency Currents, a free global macro and market newsletter. And you can find him online at blackswantrading.com. He's with us today from Palm City, Florida. Jack, welcome back to This Week in Money.
Hey, Phil. Thanks for having me.
I guess the big topic today, oil, $109 a barrel. Retail price in the States jumping overnight to $3.65 a gallon. You could sum it all up in one word, basically, and that would be Iran.
I think you're right. That, and I think some of the expectations that U.S. growth is for real. So it's kind of a little bit of a double whammy. Maybe demand picks up on, some U.S. growth, and there's some expectations that Europe is healing. I'm not sure if that's the truth, but Iran and some growth expectations, I think, are doing the trick.
And speaking of Europe, Jack, you got to feel sorry for folks there. Since the end of August, Brent crude has risen 8% in dollar terms. When you translate it into euros, it's up 18%. That is painful.
Very painful indeed. And you would think that's just another nail in the coffin for a deeper recession in Europe, and which kind of goes against what we just said, this idea of a major global growth rebound.
A couple of quotes here I want you to talk about. Nancy Pelosi saying that oil shortages, not the problem, it's Wall Street profiteering. Have we heard this before?
Yeah, we sure have. There's no doubt there was a lot of spec play in the last run in oil prices, but that's just the way the market works, and it's hard to say what type of risk premium is in now, but that's the way markets work. So if you try and take everything out of it and make everything known, you won't have a market. So it's as simple as that.
Jack, here's Newt Gingrich promising to get prices down to $2.50 per gallon from almost $4, and he's got a simple plan: simply eliminate the EPA, build the Keystone, and allow more drilling. And is that just as crazy as Pelosi's approach?
Well, it's a little bit nutty near term, that's for sure. But I do think the idea of more drilling in the U.S. It does make sense. We have a lot of reserves here of oil, and in fact, we're starting to produce a lot more oil and natural gas. So ultimately, that will help, I think, the U.S. longer term. But near term, I think those things just take time.
Okay, so near term, a lot of risks, and one of the biggest, of course, in the Middle East with the supply problem. What do you see happening in the near term for oil? Going up?
I think this will continue. I think the pressure's growing out there. Israel's talking about Iran. Iran's cutting supplies to Europe. We see OPEC really doesn't seem to be jumping into the fray in opening up his spigots. I think it's a function, too, really, of just the liquidity in these markets. If you look at oil prices, they're moving in lockstep again with the stock market. So if we see a hit to the risk assets in general, meaning hit the stock markets, a change in sentiment, I think some of that premium will come out of oil. So it really is. It really just depends, I think, on sentiment here for risk assets overall. We just see the idea of this global growth very, very much being all wet. And in fact, China just downgraded their growth again. They're expecting to grow 7.5% for the year, and that's the below, 8% GDP print that everybody was always fearing. Mm-hmm. So I think the reality of a potentially slowing China and a reality of a slowing Europe and a deeper recession could take a bite out of this oil premium.
Jack, any correlation between rising oil prices and increasing stock market bullishness?
Yeah, I mean, that correlation has been pretty tight, and it's not all, obviously it's not always tight.
Sure.
As tight as it is now. And I think that goes to, we're just seeing a lot of complacency in the market, and a lot of buying of assets in general, on some really positive sentiment. You see it, Phil. You watch TV now, and every analyst, it seems like, is extremely bullish, and we're seeing the numbers show up in the investment surveys. There's a whole lot of bulls out there again, and that drives risk premiums higher for a whole host of assets, and not just oil.
We're talking to Jack Crooks from Black Swan Capital here on This Week in Money. And speaking of bullishness, Dow Industrials flirting with 13,000 this week, best since 2008. You got an interesting angle here on your blog, a non-confirmation theory, a Dow theory, non-confirmation warning. Now, for folks who don't understand Dow theory, don't know what it is, give us a quick thumbnail sketch of why this is important.
Sure, it came from it's an old theory, stock market theory that says, in general, never trust a move in one average when it's not confirmed by its sister average. In this case, the Dow Jones Industrial Average and the Dow Jones Transport. Overall, just history shows, if you look at the averages, when one makes a new high and the other does not confirm the new high, often it's a fake out breakout, so to speak, to put it in simple terms. And this is a theory that goes back a long time, back in the early 1900s, actually in the late 1880s. And it's something that's held fairly true. It's down and dirty, and it's never always that simple, but it's especially when you have a period in which it looks like valuations are extended, it often works best, and I think that's what we were trying to point out here. That let's not get carried away with all this sentiment, because we're not seeing the move in the industrials confirmed by the transports, and obviously that's part of the problem. Transports, as we just discussed, is oil prices. They're being pressured lower, which suggests that maybe the growth isn't there, and this idea of growth down the road, maybe corporate earnings are ahead of themselves and the industrials will come back. That's basically what it's saying.
So how does what's the correlation between the Aussie and the U.S. dollar? How does that work in here?
The Aussie is the premier risk currency in the world of the major currencies, meaning it moves up on when people like risk assets, and it moves down when people don't. And it tends to tie very closely again with the U.S. stock market. And we've been watching the Aussie relative to the U.S. stock market, and it too is not performing as the Dow Jones Industrials are. So we basically have two indicators, kind of one a correlation indicator, the other the Dow theory, that suggests maybe this move is a little bit ahead of itself, and that's the point we're trying to make. We would expect to see a blow-off high in the Australian dollar if this move in stocks is for real, and we may get that, but at the moment we're a little just kind of making that point.
Jack, what do you see in the Canadian dollar?
Canadian dollar looks like it's just basing in here, and I think it's just going to take its cue from, again, what happens to stocks here. I think from a valuation standpoint, longer term, it's fully valued, the Canadian dollar, especially if our thematic that we see slower global growth. We think the Canadian dollar will tend to weaken against the U.S. dollar. Nothing major. In fact, we like the Canadian dollar a lot relative to some of the other currencies out there, even on slower growth. And we even prefer the Canadian dollar big time compared to the Aussie if we get into a negative global growth situation again. It really tends to outperform the Australian dollar during slowdowns.
Jack Crooks is president of Black Swan Capital. He's online at blackswantrading.com. We have some good news also. The financial rescue ferry just landed in Greece for the second time, and we got off easy this time. It only cost us $170 billion.
It just is amazing.
Yeah.
The rescue ferry, I haven't heard that term before, but it's perfect. Yeah, the whole deal is a complete sham. Everybody knows that Greece is going to go bankrupt. They cannot pay this back. The state is becoming completely ungovernable. This idea that the existing political parties are promising, yes, we're promising this time we're going to stick to these austerity measures. Well, they're going to be voted out of office most likely in April, so they won't even be here. Mm-hmm. So it's just another part of window dressing to try and give time for the European banking system to heal and to try and set up this ringed fence around the banks in order to try and create what they refer to as an orderly Greek default. We'll find out whether it's going to be orderly or not, but the deal is really a complete sham.
We're all focusing on Greece here, of course, in the news, but there's just as many problems in places like Portugal and Spain. Are they next on the radar?
Yeah, well, that's exactly the order that I see them, Phil, is Greek goes, I think Portugal is pretty much next, because you look at the economics in Portugal, very much follow in the same path as Greece, and unfortunately, because they're under the same program of the Troika, which is the European Union, European Central Bank, and the IMF, I guess policies that they put on these countries, and it's made their economies even worse. I know it's hard to believe, but their budget deficits are getting worse, their debt profile is getting worse, and their economies are falling quickly. And they're on that exact same glide path, I think, as Greece. Not quite as fast, of course, but I do think Portugal's next. And if Portugal goes, I think the contagion we'll see again right into Spain and into the bond market.
Lots of brave talk about a firewall from politicians, but can they really do that?
It's going to be difficult because you're running out of the limits of monetary policy stimulus to a large degree, because the European Central Bank continues to throw massive amounts of money into this market. Their leverage is off the charts, 430% leverage now. And just to give you an example, Lehman went bankrupt at 50 to 1 leverage. The European Central Bank balance sheet is at 430 to 1. So if the stimulus doesn't get into the real economy, which it hasn't in the U.S. when they threw this much money into the banking system, it's not going to get there in Europe either. The real problem is, how do they get growth in this system? And the money they're throwing now is a short-term savior for the banking system, but we have that long-term problem that's going to just beat these countries down, and that's the growth problem. The money's not going to get into the real economy. These banks are going to hang on to it. You
touched on this in your blog. $816 billion in cash that should be out there in the economy is just basically sitting in European banks.
Right. The banks are taking the money they're getting from the European Central Bank, turning it around, depositing it at central banks around the world, occasionally using it for some trades that they see, meaning they'll come in and buy some of the periphery debt, look for a pop because of all the liquidity coming in, unload that for a trade. But in terms of lending, they're not lending it, and they're shoring up their own balance sheets and their own bad debt, which they have a massive amount from all the sovereign debt of the PI pigs that we know. So it's a bad combination. If central banks are supposed to provide liquidity for banks, which they do, and banks are supposed to turn that liquidity into real lending in the real economy, that's a good thing. But that second part of that is not happening.
Jack, what's your take on this Greek government bond swap today? $275 billion bond swap, and private investors, mostly Greek banks here, being asked to take up to a 50% haircut.
Well, I think I don't think it's a big shock to the market at this stage, because we knew this was coming for a while. But what it does, and this is a longer term discussion, but they have these things called CDS, credit default swaps, out there. And part of the concern now is that the authorities have the ability to just look past credit default swaps and take these events and just turn, and just morph them into something else. Meaning, if this was a credit default swap event, which in a lot of cases it should have been called that, then the banks that sold all these credit default swaps to hedge funds and other private investors would be taking a huge hit, but they've manipulated this. So the question is, going forward, are we going to have a two-tiered investment system in Europe? Since the private investors took hits, are they going to be willing to buy this periphery debt no matter what they're told how good it is in the future? And we could have a situation in which the northern tier states get a lot of the funding, and the southern tier states, which need the funding, are not going to get it because of the games that the European authorities have been playing. So that's a serious problem, again, going forward long term. It doesn't spell not very rosy for the whole structure of the European monetary system.
And the euro, what's your feeling on the euro going forward?
Well, the euro is getting a nice big bump here, and it could go higher against the dollar. There's the concerns again that we're going to have QE3, which would be more dollar supply in the market. There's optimism in Europe because of all this money coming into the banks, and the hedge funds and others are moving a lot of money in, increasing demand for euro near term. So I think the move near term could continue, but I do think longer term the euro does go lower eventually, just based on the longer term fundamentals.
Jack Crooks is president of Black Swan Capital. He publishes Black Swan Currency Currents, and you can find him online at blackswantrading.com. Jack, thanks for talking to us.
Thanks for having me, Phil. I really appreciate it.
Coming up, Ellen Brown on This Week in Money.
Always consult your investment professional before making any investment decision.
Molycorp Gold Corp has substantial assets. Magnesium deposit, inferred 52 billion pounds. Molybdenum deposit, indicated 1.9 million tons. Inferred 1.8 million tons at 0.087% MO. Past silver producer, average 182 ounces per ton. Trading symbol, MOR. Website, molycorp.com, or phone me, Larry Ray, at 604-531-9639.
This Week in Money is archived online at talkdigitalnetwork.com.
Ellen Brown is an attorney and president of the Public Banking Institute. She's also author of The Web of Debt, The Shocking Truth About Our Money System and How We Can Break Free. You can find out much more at webofdebt.com. Ellen, welcome back to This Week in Money.
Oh, thanks.
Let's talk about the new edition. The 5th edition of The Web of Debt is out. What's changed in the new edition?
Well, I've actually just updated some things. You know, things are happening so quickly in this whole field, and I've made a few modifications in my own thinking. I'm currently working on a book on public banking, which is my new interest. I'm now head of the Public Banking Institute, as you mentioned. Mm-hmm. So we've sort of given up on trying to change things at the federal level because it's just Congress is so locked up. But what you can do is change things at the local level, which means banking. In other words, you could have publicly owned banks, state-owned banks, city-owned banks, county-owned banks. In fact, counties are looking real good right now because of this whole foreclosure crisis. There is a way that counties actually have land banks now where they put properties into a bank. Okay. And, they take over blighted, foreclosed, abandoned properties, and they put them in a land bank, and then they do something with them. But you could use that vehicle, turn it into a real bank, like a real depository bank, where the county would put its revenues, and then it could use that, do what all banks do, which is to turn their own revenues into credit, which could then be used to help fix up these properties. You could take the properties by eminent domain, and you could use it for your other banking functions as well. Basically right now what all local governments are doing, in fact all of us are doing, is putting our money on Wall Street for almost no return, and then we have to borrow it back at quite high interest rates. So if you have your own bank, you just cut out the middleman and cut out that interest spread. So that's what my thinking has evolved toward, and I've sort of, I altered Web of Debt a little to reflect that, but I'll really reflect it in this new book that I hope to have out in about 2 months. Okay.
Does the Public Banking Institute have a website we can go to?
Yeah, publicbankinginstitute.org.
Okay. We're talking to Ellen Brown on This Week in Money, the 5th edition of Web of Debt, out in German, Swedish, Korean, Spanish, Kindle version, and PDF. Just a shame there is not a Greek version, because our friends down in Greece could sure use something like that these days, huh?
Yeah.
The latest piece on webofdebt.com, how Greece could take down Wall Street. Of course, the big news this week, Greece getting its $170 billion bailout this week, but it's not really going to solve the long-term problems, is it?
No, and what I was writing about was the hazard of the credit default swaps that are riding on all that. The concern is that a default would trigger these credit default swaps, which could just trigger the whole. It could be another Lehman Brothers style collapse. In fact, it could be a lot worse than Lehman Brothers. And arguably, the reason they keep propping the banks up and keep propping Greece up is to avoid that triggering of cross defaults. So, all these credit default swaps going off at once.
Now, the CDS market is huge. The figure you have here, $32 trillion. Did you put that into perspective for us?
Well, it's twice the size of the U.S. GDP, and it's twice the size of the U.S. debt.
Wow.
So up till now, the government has underwritten the banks, but the government can't underwrite the whole derivative scheme or the whole credit default swap scheme.
Now, here's the interesting thing. 95% of the CDSs are held by 5 banks.
Yeah, so you could. That just suggests right there how you can solve the problem. You just have to deal with those 5 banks, which, you don't even have to purposely put them into receivership. They're going to go bankrupt of their own accord as soon as we have another Lehman style collapse, and instead of bailing them out like we've done before, which is actually not according to our own rules, what you're supposed to do when a bank goes bankrupt is, if it's a little bank, you sell off the assets. The FDIC comes in, takes over. If it's a little bank, they sell off the assets. If it's a medium-sized bank, they find some other bank to absorb it. And if it's a big bank, then they're supposed to nationalize it. I mean, nobody likes the word nationalize, but what they're supposed to do is the receiver goes in, pays off, the creditors stand in line. They don't bail it out. A bailout means that you come up with new taxpayer money to pay the debt. That's not what they're supposed to do. What they're supposed to do is they take whatever money the bank already has, creditors stand in line, they all take a haircut, and they divvy up the money, whatever amount of money's there, and then that's the end. And then they've got a clean set of books, and then they proceed doing banking theoretically in the public interest. I mean, the ideal model would be Sweden, for example, which nationalized their banks and got them back on their feet. Or there are many public banks globally, like, all the BRIC countries are dominated by public banks. Okay. Brazil, Russia, India, China, that's 40% of the global population, and they are the countries that are now showing this remarkable growth when the rest of us are just barely surviving.
We're talking to Ellen Brown from webofdebt.com here on This Week in Money. We're talking about credit default swaps, which have largely been under the radar for the past little while. $32 trillion. And here's the real shocker. The whole CDS market is not regulated. How did that happen?
Well, they're really they're called over-the-counter, but it seems to me they should be called under-the-counter.
Yeah.
I mean, they're really happening in back rooms. They're not on a public exchange. And so the problem is, it's like they're sold as if they're a form of insurance. But if it was insurance, you would have an insurance commissioner who would go in and make sure that the insurance company actually had the money to pay up. But that's not what happens here. You don't have to be able to pay up. And even if the original, it's really a bet. What you're doing is betting that your credit default swaps, that your some contracts that you've entered into, or that you can bet on somebody else's contracts. That's the problem. In fact, you can bet on anything. It's just like a horse race. You can bet on somebody else's horse. So even if the counterparty to your bet was solvent when you started out, they can sell that credit default swap to somebody else, and you don't even know who the counterparty is. So when you go to collect, you don't know who you're collecting from, and that party may be bankrupt. And that is what happened, like in the summer of 2007, when we first saw the cracks in this whole deal, when the two Bear Stearns hedge funds went down.
So the credit default swap market, basically unregulated. It's like a casino, except in this case, well, I guess it's just like a casino. The people who run the casino basically determine whether or not they're going to pay out.
Yeah, so that is the catch. Up till now, they've gotten away with it by... I mean, Greece has actually technically defaulted. Like, these 50% haircuts are a default. If you only paid half on your mortgage, the bank would call that a default.
So how's this different?
Well, because they get to define what a default is. So I guess because those haircuts were considered voluntary, although I doubt they were very voluntary, they got away with it. But if Greece totally defaulted, if they just walked away from their debt, there's no way you could not call that a default. And apparently Greece is now threatening to do something that's called an involuntary default. An involuntary haircut, where they're forcing the creditors to take, 50%, 50 cents on the dollar or whatever. And that is considered an event of default that would trigger off these credit default swaps.
We're talking to Ellen Brown from webofdebt.com here on This Week in Money, and you're quoting Rudy Avizius in Market Oracle. He's talking about MF Global and how they play into all of this.
Well, they were actually they were gambling as all these they're just brokers, and they were gambling, and they thought they were covered. I mean, they were buying sovereign debt, but they thought they were covered with their credit default swaps, but they were highly leveraged, like different, either 40 to 1 or 80 to 1. It's not, depending on who you read, but either way, with a 50% haircut, that clearly threw them into bankruptcy. But they thought they were covered by these credit default swaps, so they weren't worried. But it turned out because the ISDA, which determines whether it's a default or not, refused to call it a default. They just called it a voluntary haircut. The MF Global was not able to collect on their credit default swaps, and so they tried to cover by borrowing from their customers, and that's where they got in serious trouble for that, and it didn't work, and so that's why they not only went bankrupt, but they're a shocking display of corruption, as if this was a one-time deal.
Yeah.
But in fact, you can see what happened. I mean, there was some logic to what they were doing there. It was that they thought they were covered and they weren't.
The ISDA, of course, the International Swaps and Derivatives Association. This is the house. This is the casino, basically, that calls the shots.
And it's owned by big banks and hedge funds.
Okay, so let's look at the Greek situation. 11 million people, and they could basically bring the whole world economy down around its knees. Are we going to see some moves in credit default swaps in the next little while, you think?
Well, depends on who you read. Some people say that even if they triggered the whole thing, that it wouldn't be a big deal because banks they bet both ways, so they're betting with the house and against the house at the same time.
Yeah.
But then there are other people that say no, they won't cancel out. I mean, it's just not clear what's going to happen. It could be a huge, huge global catastrophe, or maybe it'll even out. But it's a huge gamble. I mean, we should not be in this situation where we're playing with people's food and people's livelihoods. That nobody really knows what's going to happen with all it. They're just inventions of the bank. These formulas that were supposedly supposed to reduce risk, and what they've done is hugely magnified risk.
Now, these guys have got to be more scared than anybody, just standing on the edge of the abyss here.
Yeah, you would think.
We're talking to Ellen Brown from webofdebt.com here on This Week in Money. And, of course, the Greek situation unfolding as we watch what's going on in the news. How bad is the effect going to be on places like North America, the U.S. and Canada, for example?
Well, that's what I'm saying. Nobody knows for sure, but it could be terrible. So we have to do something about the system. I mean, first of all, they should not be allowing... Well, one thing they shouldn't be allowing is for people to bet on something they don't own. I mean, it's one thing for farmers to bet on their own corn.
Sure.
But to allow people to bet on the burning down of somebody else's house, it obviously tempts you to go and burn down the house. And there's some, some suspicion that has happened, that the short sellers are trying to bring down Greece, or trying to bring down countries that they have big bets on.
Okay, that's the first step, and I'm going to put you in charge of the world economy for a couple of minutes here. What would you do next?
Well, ideally, you would get rid of that whole system, or at least the first thing you would do is put it on an exchange, a public exchange, so everybody can see what's going on. You know who's your counterparty, and you know what kind of betting is going on. But ideally, you would just get rid of that system. That is no kind of insurance. What they're really trying to insure against, I mean, if you want to see what I would call the big picture, the problem is that prices are completely unstable, or money is unstable. The exchange rate from as soon as you cross the border, you don't know what your money's going to be worth on the other side. Mm-hmm. So they're trying to guarantee all that by playing with these bets, as if you're shifting the risk onto somebody else. But obviously the risk is still there, and you've just shifted around to innocent people that, like some pension fund or something that didn't know really what they were getting into. So that does not solve the problem. You need to get rid of the risk, which to me means you need a more stable system, which I think means we need some sort of yardstick for measuring currencies, not a global currency like gold or like the dollar or whatever, not a global currency, but a yardstick to measure the value of currencies, so that you can tell what your currency is worth in a particular, like, say it would be a basket of different commodities and different things that people buy every day, and you put everything in a basket, and you'd figure out how much of a particular currency it would take to buy that basket, and then you can compare that across borders.
Ellen Brown is author of The Web of Debt, The Shocking Truth About Our Money System and How We Can Break Free. You can find out more at Ellen's website, webofdebt.com. Ellen, thanks for talking to us today.
Thank you.
After the break, Mike Shedlock on This Week in Money.
American Manganese Inc. has a manganese deposit in Arizona. Indicated 6.7 billion pounds. Inferred 8.9 billion pounds. Potentially the lowest cost producer of electrolytic manganese, costing only 44 cents a pound. Metal trading near $2 a pound. Do the math. Trading symbol AMY. Visit AmericanManganeseInc.com or phone me, Larry Ray, at 604-531-9639.
This Week in Money is archived online at TalkDigitalNetwork.com.
If you haven't been to Mike Shedlock's blog, just Google Mish or head on over to globaleconomicanalysis.blogspot.com. I've been going there for 5 or 6 years now. It's the place you got to go to find out what's going on. Looks like things, Mish, are going from bad to worse in Greece this week. The second bailout, but boy, there are some huge strings attached here. And it looks like Germany is the one pulling the strings.
Germany is the one pulling the strings. It should have been pretty clear, actually, all the way back on February 7th when Germany started making these what people considered preposterous demands. Actually, I considered it a preposterous demand. They wanted a European Council, some sort of committee, to have complete responsibility over the Greek budget. Of course, that was shot down by Greece, and that was also shot down by, France actually protested first. Nicolas Sarkozy, the president of France, protested. Once he did that, it was all over. But then, I just started seeing all of these demands just come out piecemeal from Germany. Typically, it was their finance minister, the one that was calling for all of these things. Mm-hmm. But you know that Merkel had to be behind some of these things, actually setting up the finance minister, if you would, sort of for the fall. I mean, he got the blame. The president of Greece, that's really a symbolic position. It holds no power, but, he came flat out and said, who in the hell is this guy to be, placing these demands? And that's exactly how he said it. But, the demands just kept coming and coming and coming. And, a few days ago, actually for about a week, I've been saying, it is clear that Germany's placing all of these roadblocks out there. Germany does not want the deal to go through, even though France does. I think the IMF is actually ambivalent as to whether it goes through or not. But most of the EU bureaucrats want it to go through. France wants it to go through. The IMF seems ambivalent, and Germany, lots and lots of demands.
So what has a $170 billion bailout got to do with liberalizing beauty salons and diet centers?
Well, I mean, these are reforms, actually, that Greece needs to make.
Okay.
I mean, there's so many ironies in this, Phil. But the Greeks' protests are essentially over the things that Greece really needs to do, instead of over the absolute absurd demands placed on Greece. For instance, 2 days ago, actually, I think this was, this was in the fine print of the bailout agreement that Greece had to sign a couple of days ago, whereas 111 tons of gold, all of Greece's gold now, is put on the line if they don't adhere to these austerity budgets, and Greece needs more money, and they're going to need more money.
Always.
That they're going to raid Greece's hoard of gold. Greece has to be absolutely nuts to agree with this. Now, mind you, I believe that takes a constitutional change to do that. Certainly some of the other things that Germany, the Troika, whoever you say, stuff these things in the channel, place these demands, require a constitutional convention. And the weird thing about constitutional amendments in Greece is they can only be done every 5 years. One was done in 2008, so that means we can't do another one until 2013. Now, the terms of the agreement that Greece had to sign was that they had to do these things, this constitutional changes, as soon as possible.
By the weekend.
Well, Yes. So there's a funny definition here as to what as soon as possible. No, by the weekend. See, this is a different thing. These were additional demands placed just today. The Troika came out and listed 38 new demands, 38 new changes that Greece needs to do, in addition to 10 prior ones. Excuse me, not 10 prior ones, 10 pages. Wow. I don't know how many that is of prior demands that have not been met. They need to meet this list by the end of the month. Now, I looked at this and said, my gosh, how lucky Greece is. This is leap year. They get an extra day.
Now, Germany's holding all the cards here in this situation. What do the Germans ultimately want out of this?
Right now, Germany wants to get Greece out of the Eurozone.
Okay.
They've had enough of these bailouts. They don't want to commit money. What's happening here is Merkel's coalition is blowing up here now. She lost a call. The president, again, a symbolic position, and why don't they name me president here? I will gladly take the position. But the president of Germany resigned in some sort of scandal, and Merkel's coalition almost busted up over it. She threatened all kinds of things if she didn't get the person she wanted. And she did not get the person they wanted because, this minor little party that was needed just to keep the coalition together, to come up to 50% of the votes, just refused to go along. So there's a lot of dissent in Germany. Germans do not want to send another penny to Greece. So it is Germany that is behind, I believe, all of these demands that are now being placed here at the very last minute. I mean, these demands just came out today, and one of the demands is for 75 full-scale audits and 225 value-added tax audits.
Wow.
In the next 6 days. That is just one of the demands. I've not seen all of them. I think there was a list on Financial Times, but I didn't read the whole thing. But I don't know how anyone does that. Bear in mind, there's 10 pages of demands that need to be met, in addition to these 38 other things, an agreement to give up their gold. Greece has to be nuts to accept this.
More with Mike Shedlock next on This Week in Money.
Molycorp Gold Corp has substantial assets. Magnesium deposit, inferred 52 billion pounds. Molybdenum deposit, indicated 1.9 million tons. Inferred 1.8 million tons at 0.087% MO. Past silver producer, average 182 ounces per ton. Trading symbol, MOR. Website, molycorp.com, or phone me, Larry Ray, at 604-531-9639.
This Week in Money is archived online at talkdigitalnetwork.com.
We're back with Mike Shedlock on This Week in Money. Mish, is Greece out of the Eurozone such a bad idea?
No, it's a tremendous idea. Okay. Greece cannot possibly recover until it's out of the Eurozone. Now, there's a decent chance if it leaves, it goes into hyperinflation. Now, if it gives up all of its gold first, then hyperinflation is absolutely 100% guaranteed.
Now, that gold is only $6 billion. It's not a big amount.
It's only $6 billion. Yeah. However, it's something. Yeah. Remember, Zimbabwe went worthless. Here we're just talking about let's assume you could, get a leverage of, have something backed in gold by, gold backing of 10%. Now we're just talking about a 60-70% haircut here on Greece. I mean, that's enormous, but if it's one time, that's not hyperinflation. Hyperinflation essentially is when the currency goes completely worthless. And you can put your own definition on it. But if it's one time and stabilizes, say they exit and devalue by 70% and that sticks, they're stuck with certainly huge, massive inflation, but it's one time, as opposed to what we're seeing, $1 trillion notes in Zimbabwe that are absolutely worthless.
No, they're worth 12 cents actually.
Oh, I'm sorry.
Now, why doesn't Germany just be upfront about this and encourage Greece to leave the Eurozone?
Because it's against the treaty. There's no way out of the treaty. I don't think Merkel wants to get the blame for this. She is one of the biggest proponents, the biggest flag wavers for the Eurozone. So her official position, which is different than what she's really doing behind the scenes, is that she came flat out and said she's not demanding Greece leave the Eurozone. I looked at that and said, okay, we've got an official denial now, and
it's a done deal.
That's from the comic show, the British comic. Actually, I think it goes back to Otto von Bismarck or something in Germany. But it's also from the Yes Minister, which is a very humorous political comedy in the 80s, where one of the British minister says, or was telling the prime minister, one of the bureaucrats was telling the prime minister, never believe anything until it's officially denied. And so I looked at that and I said, okay, here we've got an official denial that Merkel says she's not trying to get Greece out of the Eurozone. Well, I think that was the final proof that she is after all these years.
We've had a lovely time in Greece, and now we're going to visit one of the other beautiful scenic Euro countries, Spain. What's going on here?
Spain is in deep trouble. Spain, just today, I'm writing a blog about it right now. Okay. It's not even out yet. Madrid is pressing the EU to ease deficit targets, and things are looking actually very, very grim here in Spain. The Spain budget deficit is 8%. They're supposed to get it down to 4.4, and now they're begging the EU. They're begging Olli Rehn. He is the commissioner of fines, I guess, the commissioner of economic issues, but he's also responsible for fines. And, he's threatened Belgium with a fine if they didn't cut billions out of their budget. And rumor has it he's going to do the same thing here to Spain. But he's allowed to bend the rules if there are unforeseen circumstances. So
that's unforeseen by
all. So no doubt Spain is saying that there's unforeseen circumstances. But just check some of this stuff out.
Yeah.
Spain's unemployment rate is 23%. Now, what do you think is going to happen if they cut their budget deficit from 8% down to 4.4? How many people are they going to have to fire to do that?
I'm thinking the unemployment rate's going to go up.
The Spain's regional governments, this just came out today. My friend Bran, who lives in Spain, he sends me links every day from Spain. He sent me a link, and I use Google Translate. The Spain's regional governments need a $30 billion bailout. They've they're $30 billion in the hole. They've bought stuff from suppliers and they can't pay them. Okay. So, what do you do about that? Well, maybe the suppliers get stiffed. Well, how many of them go out of business if they don't get any money? Okay. So, meanwhile, Spain's mortgage lending fell 46%. Spain is already sitting on a huge pile of the Spanish banks of foreclosed properties. So now the government is calling for, you can guess this, right, a moratorium on banking evictions for 2 years in cases where no household members have any income. Well, we've got evictions stacking up. The banks are going to be stuck with more non-performing loans, and my friend Pater Tenebrarum on the Acting Man blog posted a nice chart today showing Spain's non-performing loans are at a mere 140 billion euros.
That's manageable.
Yes, relative to the size of the economy, that's 3 or 4 times the size of the economy. Wow. And now we've got this $30 billion euros on top of it. And of course, none of this could be unforeseen because just 3 months ago, all of this had to be unforeseen because the Eurocrat Nimrods 3 months ago actually predicted the Spanish economy would rise 0.7% in 2012. They've now lowered it,
of course,
to a negative 1%. But they're saying, "Oh, don't worry, it's just going to be a mild to temporary recession." Yeah, I said, Phil, let's look at the bright side of this.
There is a bright side?
There is a bright side. I guarantee you the rest of the recession will be temporary.
Oh,
they
great.
all are.
The EU has things well underhand. We don't need to worry about anything that's happening because the Eurozone bureaucrats have it all figured out. Mike Shedlock's blog is at globaleconomicanalysis.blogspot.com. And his Twitter feed, MishGEA. Don't forget also, Mish's blog, also a free iTunes app. Mish, always a pleasure. We don't talk enough, and it's great to hear from you again.
It is indeed always a pleasure to be on the show. The easy way to find me, Phil, is just do a Google search for Mish, M-I-S-H.
Thank you, Mish. Our thanks to our guests, Jack Crooks, Ellen Brown, and Mike Shedlock. And thanks to you for listening. I'm Phil Mackesy. For AmericanManganeseInc.com, we're back next week with another edition of This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.